Hello friends, good morning. Today, let us continue our studies of financial management into a topic called capital budgeting. So in this particular video, we are going to see the capital budgeting techniques considering time value of money. I hope you have understood my capital budgeting video without considering the time value of money, in which we have studied 3 techniques, and now considering the time value of money, we are going to learn 4 techniques. Technique number 1, discounted payback period. Number 2, net present value. Number 3, profitability index, and the fourth one is internal rate of return or IRR. The technique first is discounted payback period. Discounted payback period is nothing but the time required for the project to get back its investment after considering the discounted or present values of cash flows. And the decision making rule under the discounted payback period technique is, for single project, a project is to be selected if the discounted payback period is less than the life of the project. And if you have to make decision for 2 or more than 2 projects, the decision rule is a project with least discounted payback period is to be selected. After looking at this discounted method, let's go on for second technique. The second technique under time value of money is net present value or NPV. Net present value is nothing but a technique by which we can make the capital budgeting decision by considering time value of money. The formula for calculating NPV is equal to summation of present value of cash inflow minus summation of present value of cash outflow. And the decision rule comes as, for single project, a project with positive NPV is to be selected. And if there are 2 or more than 2 projects, the decision rule is a project with highest NPV is to be selected. After watching this, let's move our journey for profitability index. Profitability index is another technique of capital budgeting considering time value of money. The formula for calculating PI is summation of present value of cash inflow divided by summation of present value of cash outflow. And the decision rules are, for single project, a project having a positive more than 1 profitability index is to be selected. And for 2 or more than 2 projects, a project with highest positive more than 1 PI is to be selected. So this is a decision making for profitability index. Now let's move for the last technique, that is internal rate of return. In short, internal rate of return is the rate at which the summation of present value of cash inflow and summation of present value of cash outflow equals, or whereby the difference between both of them is 0. So the decision making or the formula for IRR calculation is IRR is equal to SR, which is starting rate, plus surplus at starting rate divided by surplus plus deficit multiplied by difference in rates. This formula can give us IRR, and the decision making rule under the same is, for single project, a project with least difference between IRR and cost of capital is to be selected. And for 2 or more than 2 projects, the decision rule is a project with least difference between IRR and cost of capital is to be selected. So the decision rule under both the situation remains the same. So this is several techniques that considers time value of money and gives the decision rules within the same. I hope you have enjoyed my video on capital budgeting techniques considering time value of money. Keep studying about capital budgeting. Keep studying about financial management. Thank you.